Yeah, we definitely think it's the best environment we've seen small caps for some time. And that largely relates to the fact that around 50% of the small cap industrial companies that we look at are exposed to the Australian economy in some way across sectors such as retail, automotive, and also building materials. As we've seen the macroeconomic data come through for Australia and also New Zealand, it's been beating expectations. So we think this will continue to fuel these companies going forward. And so we're very positive on these companies, which are largely value companies or cheaper companies that are quite cyclical in nature. We definitely think that companies exposed to the United Kingdom and the US will outperform, given how badly they've come to terms with COVID. But in terms of the reverse, I think they've actually been very good in terms of administering the vaccine. So if you look at the United Kingdom, we're positioned in companies such as Pendal, Virgin Money UK, Reliance Worldwide, and also the travel names Corporate Travel and Flight Centre. I think we'll always maintain and continue to run the Wilson Asset Management investment process. I don't think the digital uptake as such will impact our process per se, but in saying that, I think it's still very important to ask the companies when we're having meetings with management and boards, like how they're preparing for this new digital world. I mean, one of the companies we're quite positive on that we own is Virtus, which is one of the largest IVF players in Australia. Now, previously they were looking at rolling out IVF clinics globally. Now they're starting to thinking about licensing their technology through their precision fertility capabilities to other IVF players globally. So this is a revenue stream which is low capital intensive, doesn't have many expenses to it. It's a licensing revenue stream, and we believe this could potentially bring some significant upside over time to Virtus. So they're the sort of the examples that we're looking at across the companies that we own. I think the ESG trend is huge, and I think it's only going to continue. You can see a number of companies, particularly in the consumer space, where it might be, say, Coke, saying they're going to get rid of PET plastic bottles by a certain time frame. And I guess, and we saw that with Macquarie actually bidding for Bingo Industries just before Christmas, with quite a high multiple for that company. So one of the stocks in the market that we think is well placed for this theme is Pact. It's been a company that's been through its tough times over the last few years, but there's a clear, coherent strategy to increase its exposure to recycling plants. And we believe that this will improve their competitive positioning with their customers going forward. So we quite like that company. Geez, this is a big question. I'm going to talk about a random one, and it's Link Administration. Now, it's clearly not the funds administration business that I'm talking about here. It's their 44% investment in PEXA, which is Australia's sole digital e-conveyancing business. Now, why we like PEXA is if we go back in time when they tried to have their initial public offering at the end of 2018, the numbers have consistently beat those forecasts. So if we have a look at Link's recent first half result, earnings from PEXA was around $50 million. So it's actually tracking ahead of forecasts and actually has over 75% market share in conveyancing in Australia. So we see the ability for this technology to be rolled out globally, and I think the United Kingdom might be the first region that PEXA expands to. So we're always trying to find a business that could expand globally and then potentially has a valuation that might be on the high side to get in the ASX 20. Now, this certainly won't happen to tomorrow, but I'm going to say Link Administration. It's really PEXA, their investment. We've had a really good period. Team's done very well following the Wilson Asset Management investment process, but we did call e-commerce very early around sort of March and April, and that did very well for us in sort of the probably up to around October, November. Travel's been a very good sector for us. We bought a lot of those companies through June, July. It was a very non-consensus call at the time. But these stocks are also heavily shorted at the moment as well. So I think they've probably overachieved in terms of where their balance sheets are and their cost base. And I think through November, we got hit pretty hard when the vaccine announcement came. I think it took us by surprise in terms of how strong the efficacy levels were, but we repositioned the portfolio pretty quickly and have done well with a number of cyclical names in the portfolio since then. One of the companies that we quite like at the moment is our largest position in WAM Capital's Virgin Money UK. It's the old Clydesdale Bank that used to be owned by National Australia Bank. It's a very cheap stock. It's trading at a 30% discount to its book value. And the work we did, the team did effectively, we spoke to a number of UK banks globally, and I don't think it couldn't have been more negative at the time. And you could see in terms of what these banks had done, they'd heavily provided for problem loans through 2020, given the onset of COVID. And I think you only had to look at the Australian banks as an example of what they've done, 9 months earlier. And clearly the outlook for Australia is a lot better, and we're starting to see the feeling that these provisions will be written back. So it was a very simple thesis. And we actually think over time, once UK comes out of lockdown, the vaccines rolled out, the economy will be very strong. We'll see those provisions wound back. And we think we'll start seeing a credit growth cycle in the UK, which will really benefit Virgin Money. Yeah, a company that we've owned for a long time, it's done very well for us, is Enero. The ticker is EGG. It's effectively the old Photon Group. So it was an advertising company, and we really went through some bad times, from 2007 really up to, call it, 2016, 2017. Management did an incredible job fixing the balance sheet, selling non-profitable businesses and so forth, but the business had fundamentally changed. So it has strong exposure to the tech companies in the US through its public relations company called Hotwire, and it also has a digital platform for advertising called OB Media, and that was the one that really shot the lights out at the first half results. So we think the balance sheet's incredibly strong. We see the ability for acquisitions going forward, and the valuation is still very, very, very cheap. I think it's on around 8 or 9 times PE, and it's net cash. So we really like that one, and that's our biggest holding in WAM Microcap. The checklist to find those pre-IPO opportunities is still the same as what it was in the Wilson Asset Management investment process. So we're looking for a company that can grow strongly above its valuation, very strong market sector that it's in, and also very strong management team, and we want a catalyst. Now, the management team, I think, for pre-IPO investing is incredibly important. We want to know the history, we want to speak to the board, but the most important thing is we want that management team aligned with us. So are they doing a pre-IPO just to cash out, or are they doing a pre-IPO to accelerate growth? And for these reasons, we're very picky across the pre-IPO investments that we participate in, and we want to see alignment from the management team for that company. The company that we own pre-IPO is a company called Expansive. Effectively, what they're trying to do is call it the ASX, or a trading platform for carbon credits. There's some very big shareholders that are already on the register, which gives us greater confidence. And it's a business that's been around for a long time. It's been very entrepreneurial in terms of the guys that started it up, but they've done the hard yards, and certainly seeing the benefits coming through in the numbers. So I think we might see an IPO of the company later in the year, and certainly one that we're quite positive on. It's interesting because there's a lot of talk around the shift from growth to value over the last few months, and you look at it and it has been quite rapid, but I think it's worth pointing out that the valuation difference or divergence between growth and value is still the highest it's been in 50 years. So there is still a way to play out here. So our view, we're underweight the technology sector. We have been for some time. And we think we wouldn't be buying any of the dips that we see in the market for that reason. So we think we're going to have a very strong period of economic growth. We'll see inflation, and that will hit the technology sector. So yeah, as I said, we're very lowly exposed there. I guess sort of on that theme, and it hurt at the time because we made a portfolio call across e-commerce, and there was a sector that did very, very well for us. And one company was a large holding in the fund, well, one of the largest actually around October, November was Redbubble. And it was a hard one because we just thought that we'd done very well out of the stock, and we could see the stock upgrading earnings over the next few months, had a very strong balance sheet. But we just thought the market had changed. And our other concern with it was when you stripped out the mask revenue that they were getting, their core business was actually, wasn't growing as fast as we thought, and was actually cycling a very weak period 12 months earlier. So look, we sold out at around $6. It's around that mark now. Does have a good CEO, it has a very strong balance sheet, so time will tell whether we're right or not, but we're certainly happy with our decision to sell out. We've been saying for some time the inflationary risks, and that was our sort of, one of the reasons why we've stayed liquid across all the portfolios in the last 12 months. We're starting to see those risks come through at the moment with yields and so forth around the bond market. Now, we don't think there's cause for concern yet, And we think inflation is actually a pretty good thing, really, because it's a reflection of economic growth. So it's definitely not panic stations yet, but I think that's certainly what we're watching very, very closely, and it's a big reason why we're underweight the tech sector. Without sounding like a broken record, because we have been negative on the tech sector for some time and been totally wrong, but there are a lot of there's just some craziness in the market at the moment. Companies that aren't making money, aren't going to ever make money. There's a lot of companies there's a lot of good tech companies, there's a lot of bad tech companies, and I think they all look exciting, particularly for retail investors. Seeing all the stuff, the Reddit army over in the US with GameStop and a few of those other names, it just feels to us that there's just a lot of frothiness in the market. So that is a sector we're definitely watching, and it's a key reason why we're underweight. It feels like the retail as a whole loves this sector. And so any stock they see that's potentially a concept stock, it's a great theme, or people love Elon Musk and Tesla, they're trying to find the next company like that. That's what worries us. There's just so many pretenders in this space, and there just seems to be a total disregard for valuation at the moment in the market. And this is why you're seeing these huge spikes on a daily basis, and makes it incredibly volatile. What's keeping me up at night? It's just been a crazy 12 months. I think, in March you had COVID, in April you had the COVID recovery, in November you had the vaccine, and now you've got a shift from growth to value. So I guess waking up every night and trying to work out, are we going through another rotation again in the market, is probably what's keeping me up at night, to be fair. What am I excited about? I'll tell you what, I'm excited for a holiday, going to Queensland and going to Port Douglas. That'll be good, if I can get there. But in terms of what we're excited at WAM, we always like finding undiscovered gems, and I guess one sector we quite like at the moment, which probably is the worst sector coming out of COVID, is the aged care sector. We just think it's bottomed, and it couldn't get any worse. And certainly the outcomes from the Royal Commission, although they haven't been, we'll need to wait for the budget to see what the final outcomes are. But we think it was a very positive outcome for the aged care sector, and we quite like Estia here, which is quite a large position across WAM Microcap and WAM Capital. It's got a very strong balance sheet. And we also like Regis Healthcare, which plays this theme as well. And they'll also benefit from higher property prices. So that's a sector that we're quite excited about, and it's a sector that we think is sort of forgotten about in the market. Well, I thought it was interesting and very timely for that question, given what we saw last night in the market in the US. I think we saw the NASDAQ was up, I think, 4% after being hit very hard over the last few weeks. The S&P was up, I think, close to 2%, and Dow was flat. Now, interestingly enough, it was only the 5th time since 1996 that we've seen the S&P up over 2%, but the vast majority of the members of the S&P were actually negative, were down. So it just shows you how concentrated that rally was in a lot of the frothy stocks, such as like a Tesla, which I think was up 18%. So that's a bit of a crazy statistic, and shows you sort of how volatile the markets are right now. Yeah, so I started my career on the sell side at a broking company called CLSA. I was writing research, and I was actually very bad at it. Had a love for the market, but I'd just take too long to write research. It was terrible, to be blunt. And I think I always covered 10 stocks. I could never get above 10 stocks because it just take me too long. Always had good ideas, but I felt I had good ideas, but it would take me months to write the research. So I was always attracted to a career in the buy side, because you just have a broader range of stocks to look at across a variety of sectors. You're always learning. Every day something new happens. And that effectively got me the job at Wilson Asset Management and to portfolio manager today. So it's a forever evolving job, and it changes every day, but we love it, and it's fantastic. Well, it certainly wouldn't be farming, because that's why I'm here today, because I suck at farming. And if you just ask my parents, they'd say the same thing. But I always loved sport in some way, and I did law when I was at university. Also sucked at law, to be fair, but I think I think something along the lines of sports management, player management, or just involved in administration somewhere would certainly be interesting. But yeah, I've always been very keen on markets, so yeah, I think I'll definitely be doing this for the rest of my life. Clearly, I work with one of the best guys in the market, Jeff Wilson, and learn a lot from him every day. And that's not just in terms of running a portfolio, it's running a business. And I view there's no one better than that in the market than Jeff in terms of how he treats his shareholders and so forth. So look, Jeff is clearly a huge mentor to me. A lot of guys I looked up to particularly when I started as a portfolio manager and learning, learning the ropes and not getting, I guess, stressed and so forth when things go against you and really backing your views. And so there's a number of guys in the market that I do look up to and speak to quite regularly and get a lot of advice from. And they're sort of younger guys who've been in a similar situation as myself. So might do that over a few beers at somewhere in the eastern suburbs for lunch, but it's always a good catch up. It's always thinking 12 to 18 months in advance, I think, is the best lesson I got from some of my mentors. And always backing your own view. There's the thing with the market, and particularly when you're on the buy side, there's just so many different views out there from stockbrokers, from the newspapers and everything like that, and it can pollute your ideas. And always the best ideas come from you. And so if you're always thinking 12 to 18 months in advance, that means you're thinking longer term and you're thinking about the sectors that perhaps no one's in or thinking about at this point in time. So that's probably the greatest advice I've gotten from someone.